So Al, as we ended that last segment, we talk about the tools that the smart money is using to create income in the markets. They use probably different things than the public is using, right? Now, for income, when they're doing that, they are basing decisions off of a price chart or price, not emotions, not buying Apple because the Apple phone is so cool, or buying Amazon because I love to get Amazon packages. They're basing decisions based off price and what they think these companies could be doing in the future.
Sure.
Right. So, what are some of the other tools do you think that the smart money is using to create income? But the great thing that the public just doesn't know, these tools are also available to us as well. So let's dissect that a little bit.
Yeah, that's the ironic thing, is that the tools are available to us, but not taught to us or really exposed to us by Wall Street, by the smart money. And one of the reasons is that these guys are in business to make money, and a lot of their money is made by trading. And if you're trading, if you are a buyer, what do you have to find?
You have to find a seller.
You have to find a seller. Now, would the smart money buy something at a very high price, an overvalued price?
That's doubtful.
No, but if they are selling something at a high price, then they have to find somebody willing to buy it at a high price, and that's typically the public, and vice versa. When they're buying something, they're buying low, which means they have to find somebody to sell low. That's the public. So they really are creating a situation where you're doing the exact opposite of what you should do, because you should buy low and sell high, but you're doing the opposite, and you're really kind of conditioned to do that by the tools and the rules that Wall Street is using. And you mentioned short term. Well, there's a difference in the way you approach the markets for your short-term goals. Your short-term goals are your long-term goals. And the institutions are doing that, but they are putting their clients into something that really is only that one way, that long-term type of an investment, which is, we call it buy and hold. And that's a portfolio that you are told is has a long-term objective, hold on to it for decades and decades. But what happens, and this is one of the tools that the smart money uses, what happens is when we go through a major drawdown, like we did in the year 2000, the year 2008, and in March of 2020, what happens is that the people that are supposed to hold on for decades, the pain takes over and they start selling. Mm-hmm. And who are they selling to? They're selling to the people that told them to hold on and don't sell during the drawdown.
Which is the smart money.
So that's one of the tools they use. Here's some of the other things that people probably never have heard of, or maybe you have, but it's what I call the by the way strategy.
Let's hear that one.
And that is where let's use this as an example. Let's say that somebody has $10 billion they want to put into one position. They want to buy 64 million shares of a particular stock.
I think I know where you're going
You
with
know
this.
Who that is?
Mm-hmm.
It's somebody's uncle?
It's Uncle Warren.
It's Uncle Warren. Well, and he did that. He put $10 billion into IBM stock. And then he knows people like to follow him. So do you think that Warren Buffett came out with an announcement before he started buying IBM shares and said to people, hey, here's a FYI, I'm going to be buying 64 million shares of IBM. You might want to get in with me. No, what he did is after he was done filling the full complement of orders, he said, oh, by the way, I have a position in IBM.
Yeah, he's basically like that blackjack player. He's not going to show his hand until the cards are done.
Yeah, and Warren Buffett's not the only one. That's what the institutions do
right.
too. So let's get back to the short-term situation you had mentioned. If you have goals that are short-term, can you hold on to something for 10, 20, 30, 40 years and achieve those short-term goals? No, there are strategies and assets that can be used that are more beneficial and will help you to achieve those goals. That's why the institutions use them, because they have very short-term goals, and they understand the benefits of them, and it's not just from a time standpoint. These are investments that you can make that you'll achieve the entry and the exit in a short period of time. So it really is applied to those short-term goals. We talk about these in these classes that Josh has been talking about. The institutions do that, but in addition to that short-term time frame, those assets typically have leverage. which is simply a way of multiplying the value of every dollar that you have. That's huge. That's a huge benefit. It really gives you greater usage of your capital. It allows people with smaller amounts of money to participate. And when we have students come in, most of them are familiar with that long-term strategy, which is comprised of stocks or mutual funds. By the time they're done with our classes, they typically, I'd say 90 to 99% of them decide they want to learn how to trade one of these shorter-term assets. The leverage is there. With a couple of them, you can trade 24 hours a day. So these classes are a great way for you to get exposure to these, see if it's something that might fit within your goals.
You're exactly right. No matter what your objective is, there's different tools for that. But just to clarify something, as what Al was talking about earlier with, the smart money needing to find a seller for their buy, right? In trading and investing, you don't have to go and look for a seller. The platform actually will do that for you. And the great thing about our sponsor, Online Trading Academy, they have their own platform. It's a proprietary platform. It's called Click, and that's designed to help you make better investing decisions, but also to find where your price entry point might be, where your exit may be. And that way you can do that with a lot more confidence. So there's a lot of tools within there to help you make those better investing decisions. Al, you mentioned something that a lot of our listeners may have heard about or may know the concept of it, but don't really know how to apply that in the financial markets, and that's leverage. It's imperative to leverage yourself into these financial markets because you can be more capital efficient. What are those two assets that you were referencing that a lot of people like to get into because of the lower barrier entry by the broker?
Yeah, actually, there's three, but the two primary ones that you're thinking of are the futures market and the foreign exchange market. Those are markets that we, as the public, as retail traders, we have access to. They're markets that not only the smart money utilizes, but major corporations utilize and really have to use to boost the bottom line of their business. Futures is just simply what it says. It's looking at what the value of something will be in the future. The foreign exchange market is where you're looking at the difference in exchange rates between two different currencies. We have classes that go into detail on each of these assets, teaching you what they are, how to use them, why you use them, and how that leverage can work in your favor. They're both great assets for people that want to approach the markets from a short-term basis. The Forex market can be used short-term and long-term, and they both trade 24 hours a day. So you have a lot of opportunity there that's not available with the stock market.
I just want to make sure our listeners pick that up. They're 24-hour markets. I mean, think about this. A lot of people work during the day, and I mean, we talk to a lot of people, and when they come into these investing classes, they say, "Oh, I want to be able to trade and invest, but gosh, I work during the day. I got to try to do it during my lunch hour. It's tough." These markets are open in the evening. Perfect timing for a lot of people that work during the day, because if you say you take some time in the evening to do that, that's probably that best time, especially the Forex market. That's a world market.
Correct.
You have other countries basically up and at them for the day in the evening our time. Same with the futures market. These are open around the clock, but it does allow that leverage basically to be more capital efficient.
Right. Yeah, and there's also great diversification there. And even Wall Street will talk about diversification. That is actually what they will say is their protective strategy for portfolios. So instead of having all of your stocks, say, in technology, maybe a Wall Street diversification would be some tech stocks, some healthcare, some financial, some consumer staples, some consumer discretionary, and they'll say, yeah, now you're well diversified. Problem there is that they're all in the same market, the stock market.
I think back in last year, I think they all went down.
They did. In 2008, the S&P 500 is comprised of 11 sectors that cover pretty much all the sectors of the economy. In 2008, every one of those was down. I think the best performing one was down close to 40%. So diversification, true diversification, which is important, is holding things that don't have an impact on something else. We use this example a lot, where gold and the S&P 500, for example, typically they're inversely correlated. So if the stock market is going up, typically gold will go down, and vice versa. Well, there are assets that have no correlation, no really no correlation to the stock markets at all, like some of the commodities, corn, sugar, your favorite,
Lean hogs.
lean hogs. I don't believe we've had a show go by since you first mentioned that about a year ago where we
I
haven't
know.
mentioned lean hogs.
But I gave you the thunder last week. You got to do it.
Wasn't
that fun?
It was a lot of fun. Yeah, I can't remember when I've had that much fun, Josh.
Maybe next week I'll let you try one more time.
I'll pay you money.
I'll take it too.
Okay, but what happens in the corn market or the sugar market really has nothing to do with the S&P 500. So you get the ability to be diversified and to have assets in something that won't be impacted if another part of what you're holding is negatively impacted, and that's important for that confidence in your investing. It's important for consistency over time. So those markets also, in addition to the leverage, which allows you to really maximize the value of your investments, the 24-hour trading, you also get good diversification. There's another leveraged asset that's options. Options are probably the fastest growing market that is out there. And to be honest with you, a lot of the new people that are coming into the market, they're putting their money in options, unfortunately, without knowing what they're doing, which is never a good thing, especially when your assets are at stake. So these are great assets to trade. They're great if you understand how they work, why you use them, when they use them, or when you use them. And those are all things that we go over in these classes.
Yeah, I'm glad you brought those two different leveraged assets, and you also brought options up as well. I'm going to let you have some fun in the next segment. I want you to dissect kind of what options are and what people are utilizing them for.
I don't have to pay you to have fun with that, do I?
Not this time.
Okay.
Not this time. But this is a IOU. That sound okay?
Oh, okay.
So when you talk about the smart money, and you were doing that earlier, how they are using these other assets, the futures and the forex market, it just allows more opportunity for us as the public or the average investor to trade any time of day. But you have to understand where to find those tools, where to find those different oil, where to find gold, how to utilize it. Online Trading Academy, our sponsor, teaches classes that teaches you the tools to use, especially if you're brand new into these financial markets. If you haven't traded before, but you've been thinking about it, these are the classes for you because it gets you started. Now, coming up next, yes, we are going to talk about options, but we're going to talk about it in the retirement bucket. We have two buckets. You have an income bucket and you have a wealth bucket. This next segment, we're going to talk about that wealth bucket and how the institutions or the smart money, what are they using as far as what type of tools to manage and protect with their life savings. We will be right back.